Hi, everyone. Today, let's talk about where you should invest $10,000 if you're just getting started. We'll go over some basics, then we'll go over some alternatives, then we'll go over each of the funds, and then see exactly what that would look like on paper. If you like investing and making money, definitely like and subscribe. I make videos every single day, so make sure you hit the bell so you don't miss out on any future content. Welcome to the Portfolio Bulletin. Let's get started. My assumption with this video is that you've paid off all of your credit cards and any kind of high expense debt, and that all of your debt, maybe like a car payment or a house payment, or even student loans, any kind of loans that you have, are below 5 or 6%. So if that's true, then you should have your reserves in your savings account, and you're getting a pretty good return on that, right around 2.5 to 3% at any of these various banks here. These are available right now, and as the federal funds rate goes up, you can get a guaranteed return of 3% on your savings accounts. So assuming that all of that is in place, let's move on to where we should actually invest our $10,000. The easy answer is I bonds. This is any money that you don't need for at least a year, and you can give to the government at a rate of 6.2%. Of course, this is a variable rate, and they will issue these on the 31st of October. Then they will have a new Series I rate, which you can do the same investment, but the rate might change. I don't expect it to go down anytime soon. So the next batch of I-Series bonds still should be pretty high, and they can make adjustments every 6 months on these. So you can see they make adjustments every 6 months, and you can hold them for up to 30 years. But remember, that rate of return that you're earning could go down. So as inflation goes down, it could return less. And you must hold these for at least 12 months. The other benefit here is that you do pay federal tax, but you don't pay any state or local tax. Also, they do have some minimums here, so you can do 25, 50, 100, 200, 500, or 1,000. To be clear, you can do down to the penny if you do electronic I-bonds versus paper bonds. And there is a cap here of up to $10,000. So this is a good option if you don't need this money anytime soon, but be prepared to remove this money from I-Series bonds if this rate goes down. For the purposes of this video, I will use M1 Finance because this is my broker for stocks that I buy and hold. They don't charge any fees and they will hold your money. They also have a spend account as well as borrow if you want to use some leverage, and a pretty good credit card. Definitely check out the link in the description if you want to get an account with them. So the first investment is the S&P 500. I know it's pretty generic, but it is a good one. It has returned over 10% for the last 5 years, and you can see it pays out a dividend every single quarter. Obviously, it's not been great year to date, down 18%, but over the long term, this is one of the best performing assets. This specific one is VOO. It charges a very low expense ratio. You can see dividend yield at just over 1.5%. And if you want to use margin, it is available to you here on M1 Finance. And just for a little bit more background here on the S&Ps, this index was invented in 1926, and it only tracked 90 stocks, and since inception it returned 11.82%. It switched over to 500 stocks in 1957, and since then it's returned 11.88%. So despite some ups and downs, overall it returns more than 11%, almost 12% annually. As an alternative to the S&P 500, you have Vanguard Growth, or VUG. This is Vanguard's NASDAQ fund. You can see over the last 5 years, it's up more than the S&P, so it does have a higher potential for growth, does not have as much of a dividend yield, slightly higher expense ratio, and you can see a higher beta here. Still can use margin, and you can see all the stocks that they're invested in. It's all of big tech, basically everything that's in the NASDAQ. Next up, we got Fundrise. This is the real estate piece of this investment. I think Fundrise is better than anything really on the public markets in terms of real estate investing. So they are who I use for real estate investing and what I would put in this portfolio. Otherwise, if you want something publicly traded, we have VNQ here. Over the past 5 years, it's only returned 1%. But with dividends, it would be higher than that. And you can see here, dividend yield is pretty high, 3.75%. Expense ratio is not too bad at 0.1. Can still use margin here. And you can see the different stocks that they own in this fund. Next up, we have some bonds. This is inflation-protected treasuries, similar to the I-Series bonds, but here on the open market and tradable. You can see over the past 5 years, it's only down 3%. But the dividend yield is almost 6.5%. Expense ratio very low at 0.05%. Can still use margin here. And it's almost 100% invested in sovereign treasuries. So big dividend yielder here, and it protects your money over the long term. As an alternative to STIP, there is the total bond market, or BND. You can see it's down quite a bit more over the last 5 years. But this was valued at over $89 here in August of 2020. And currently it's trading at just above $70. And it was a little bit lower than that recently. So if you buy it at $70, maybe at some point in the future, it could be worth almost $90. Or it should at least return to this kind of mid-range here at $80. So there's some potential for capital appreciation here. Dividends still a little bit higher than the S&Ps, over to almost 2.5%. Pretty cheap expense ratio here. And you can see here that it's invested in quite a few different types of debt. So they got municipal, some temporary mortgage-backed securities, some treasuries here, and corporate debt, being the biggest holding at 18%. So a little bit higher yield, a little bit more risk, but it's pretty widely diversified and has potential for some higher gains. And then lastly here we have a high dividend fund. This is the iShares Core High Dividend Fund, or HDV. It's up 20% over the last 5 years, but it's worth noting here that year to date it's up 2% versus the S&P 500, which is down 18%. So it definitely protects your money a little bit better than the S&Ps. Still gives a pretty good dividend here at 3.5% with a low expense ratio. Still use margin here. And then you can see the stocks that it's invested in, mostly very well-established businesses that pay high dividends and don't go down very much when the rest of the market is going down. As an alternative to HDV, we have the Vanguard Dividend Appreciation Fund. You can see over the last 5 years, it did return a little bit more than the S&Ps here. Dividend is a little bit higher than the S&Ps at almost 2%. Expense ratio is a little bit higher here at 0.1% versus the S&Ps, but there's a little bit less beta risk. And you can see some of the stocks that they're invested in, putting a higher weight here on Johnson & Johnson, Microsoft, JP Morgan, and MasterCard, some of the stocks that pay the biggest dividends in the S&P 500. So let's take a look at what this portfolio would look like. About 50% in stocks here, expecting around 12% returns. I did put some alternates here, so if you wanted to do like the NASDAQ, we have VUG here, which is the Vanguard Growth Fund. It has historically been outperforming, but it's down a little bit more than the S&P, so that's a trade-off that you might want. For real estate, we have 25% of your overall portfolio, expecting around a 12% return here as well. And then for alternates, we have VNQ, which is the publicly traded Vanguard Real Estate Fund. Or if you wanted the Fidelity Fund, I think it's FREL here as well. And then for bonds, we have STIP, $1,500, so 15%. Expecting around a 6.5% return because of that high dividend, or you could invest in maybe the whole bond market at BND. Right now, I think STIPs are a better value, but if you want a little bit longer term growth potential, BND might be better for you. And then we have HDV, that high dividend fund at $1,000 or 10%, expecting around 7% returns there. And if you don't want that one, you can use VIG, which is the Vanguard Dividend Appreciation Fund. These are companies that have a growing dividend and have some potential for capital appreciation versus just that dividend return. Overall, your net return should be somewhere around 10%. And after that first year, you should plan to have around $11,000 at the end of the first year. I also want to highlight here, you definitely don't need $10,000 to get started with a plan similar to this. Any amount of money and get started with similar ratios, build up to that $10,000 and see how it grows from there. Don't think because I don't have $10,000 that I can't even get started with investing. M1 Finance will let you get started with basically any amount, and Fundrise is very similar. Comment down below what you think of my plan to invest $10,000 if I had to start right now. What would you change, or what have you done that's the same? Definitely like and subscribe if you like this kind of content. And make sure you hit the bell so you don't miss out on any future episodes. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your investing and have a great day.